Welcome to the Hungry Realtor Podcast, your go to source for things all residential real estate. I'm your host, Hungry Realtor Mike Severance, and today we have a special guest who brings a wealth of knowledge and experience to the table. Please join me in welcoming Aimee Devries.
Hello.
Aimee is a highly respected mortgage broker with over 20 years of experience in the mortgage industry. She's a graduate of Seneca College and has helped countless clients navigate the complex world of mortgages to achieve their dreams of home ownership. Aimee, thank you for taking the time to speak with us today. I know you have this wealth of knowledge. I've benefited from it personally. Aimee has helped family members of mine, both my dad and my in laws, get mortgages and refinance. I've known you for, I guess, almost 10 years now, right?
I know it's been
Uh,
yes, it's funny
I
how time flies.
I just want to jump right in and ask you. One of the things I really respect about you is that no matter what someone's financial standing is, whether they have a credit score of 450 or they have a credit score of 850, you're gonna dig in and help them with what they need. So
Mhm.
tell me, let's start on the low end because I know a lot of mortgage brokers, especially in the last few years, if you didn't have a great score, they didn't have time for you. And they kind of kicked you to the curb. But you really dig in and help people. What does that credit repair work look like, and what steps can someone take to improve their credit score?
Yes. So I will oftentimes have realtors tell me, "Oh, I do get these clients, but I don't feel like wasting your time. Like I'm not sending them to you." And I say, "No, like I always send everybody to me. My job is number one to help pre-qualify your clients, but then also give people some guidance so that they will eventually become first-time home buyers." So even in just the initial conversation, um people normally know what's going on with their credit. Like they'll know if it's not good. So I'll ask them some questions like, what has happened in the past to your credit? And they'll explain it to me. If I think it's on the cusp of being okay, I'll pull a credit report so that we can actually dig right into it and see exactly the fine details that we can quickly fix to move them into the space to start being able to purchase. But nobody ever explained to these poor people how to manage credit. Like it should be a course that they teach them in high school. So with credit repair, um, I just the guidance that they get, they're so thankful for it. And then I do a follow up every 6 months or so just to see how they're doing. But if they're really into it and they want to quickly fix that credit themselves, they'll call me back. I'll say to them, give me a call back in 3 months and tell me that you've been doing these steps, and then let's pull a credit bureau. Did you want me to go in and discuss like exactly how credit repair works? Like
Yeah,
what
that would be great. I think the listeners would love it.
Okay. So the credit bureaus, there's three different credit bureaus when we pull a mortgage credit bureau. It's called a tri bureau. There's a TransUnion, an Equifax, and an Experian bureau. So all three scores pull up. All three of these credit bureaus score differently. So they have their own algorithms. But just to make it easy for my clients, I explain to them that the algorithms are monitoring your behavior, your credit behavior. So, do you access credit every month?
Mm,
Are you requesting access to credit a lot? So, are you a credit seeker? When you have this credit, how are you using it? Are you paying it on time? Are you maxing out the credit?
mm.
So, one thing that they don't tell people is that having your credit maxed out is oftentimes just as detrimental as not paying it on time. So,
Interesting.
if you already have a lower credit score and you don't have any credit, I need you to get credit. So, I'm going to have you go to your bank and get a secured credit card. So, they'll give you that secured credit card, and you need to be careful with it. I always tell my clients, you're not using this credit card as a normal person. You're using this only for the purposes of rebuilding credit. So you want to keep your balances on that credit card below 30% of the limit, always. If that credit bureau goes in and pulls that information at a certain time of the month and it's got a limit of 300 and you put a $200 balance on it, negative hit. So people often think too that just paying off credit is going to help bring their score up right away. That's not really always the case either. It is time and consistency. So the sooner you get that credit card, the sooner you're using it every month and paying it off and making sure that the balance is always below 30% of the limit, the faster that score will go up. So the longer that you can keep that going where you've got good repayment, you're utilizing credit, you're keeping the balances low, the higher your score will be. And that's really how somebody winds up at an 800 credit score. It isn't just because they paid off all their debts and it automatically shot up. It's because the bureau is keeping an eye on how you've been utilizing credit over a certain period of time.
So there's no easy fix, right? Like, is what I'm hearing. But I see these advertisements and or internet internet pop-ups that say, credit
Mhm.
repair now, fix your credit in 2 weeks. Like, what are some
Mhm.
misconceptions about credit repair, and how can people avoid falling for scams, so to speak?
Yeah. Okay. So we do have some tricks. Like if I have a client that's at like a 670 credit score and it would save them on the interest rate to get them up another 10 points, there are some little quick fixes that we can do to boost the credit score. However, to keep your score high on a regular basis, it is behavior. Now, I don't know the ins and outs of these companies that you pay to rebuild your credit score. I just know that you could do it without their help. So, oftentimes, when I speak to my clients and they've already paid hundreds of dollars every week or month to these companies to have them do whatever, I feel bad. I feel like they've been taken advantage of.
Mm.
Um, so the other thing that these credit companies do is they'll register disputes on trade lines. When a dispute is registered, it's not doing anything to help your credit. All it's doing is halting the information from hitting the credit bureau. When you go to purchase a home, those disputes need to be removed. So if
Mm.
there was any negative information attached underneath that dispute, it will eventually come back and hit you. So I always ask my clients, if something's in collections, did you like did it actually happen? Did you default on the debt? And there's no shame in that. We've all been in a place in our lives where we couldn't keep up or we didn't understand how debt worked. So if you did it, just deal with it. Like call that credit company, ask if you can negotiate to get pay something lower. Can you be put on a payment plan? But don't hope it's going to go away because it's not going to go away. Those credit companies that you're paying money for, they're registering disputes and basically they're just negotiating with those creditors to try to bring down the balances you have to pay. And you can do that yourself with just a little bit of your own diligence.
That's a great answer. Thank you. So let me ask you this: other than poor credit, what are some of the other challenges facing home buyers today? Especially with interest rates going up, are you seeing
Mhm.
that that's a big problem for people that are having to adjust their budgets or bow out of the home buying process altogether?
Yeah. So credit, I mean, even in a good interest rate environment, lower credit is still something that if we can get you to be able to purchase, there are still programs out there like an FHA loan where you can have a lower credit score and there's still good interest rates available to you. And it will help you get into the home and be able to start paying down your own debt rather than paying off somebody else's debt. Um, the increase in rates, it does make it difficult for clients to be able to afford that monthly payment.
Mhm.
So it's not like they can't afford to buy that home because they most likely still can. There are some times where the rate might come up high enough that it disqualifies them from buying, but more often than not, that's not the case. It's really just finding comfort in the fact that that monthly payment is going to be a little bit higher. I do try to have conversations with my client about the fact that, you guys were prepared. You're ready to buy this home, and buying real estate is still a good financial move. So, if you can make yourself comfortable with the monthly payment that as it is currently, I'll also run them scenarios on what the monthly payment will look like if the rates come down by 1% or
Okay.
2% or 3%, because they will eventually come down, at which point all of my clients are in my database. We will be refinancing them and we will be moving them into those lower payments. So if they look at it as kind of that, it doesn't have to be that monthly payment for 30 years.
Okay.
Um, and can you make it work for the time being? So just I think like preparing your clients with information is probably one of the best things that you can do for them. I feel like the more information they have, the more empowered they feel, the more comfortable they are buying a house. Like buying a house is probably one of the best financial moves you can make in your life. So how can I make them feel comfortable about that?
Great. So you mentioned FHA. That brings a thought that there's basically three most common types of mortgages, right? The FHA, conventional, and VA. Obviously, you need to be a veteran to do VA, but how do you determine the best mortgage for a particular client?
Okay. There's actually 4.
Oh, cool.
There's one that's a little like, it's not as common, it's called a USDA loan. So those are more property oriented, it depends on where the property is. USDA has zoned certain
Mhm.
areas, more rural areas, um, to be under a program where they're just trying to get people to move into those areas. So it's a 0% down um, program to help first time home buyers to move into those areas.
Yeah, South
But
Jersey
you are
has a
correct.
lot of
Most
spots.
times it is not going to be a USDA or a VA loan. So um, with each client that does a pre-approval, they're like a Rubik's cube.
Okay,
So as they come
interesting.
through, I pick up their application and I have a system where I go through each part. Like there's the client's credit, employment, assets, where they're looking to buy, what are the property taxes and the purchase price like. And then there's a plethora of programs. So underneath conventional and underneath FHA loans. So we kind of move them, I kind of move them through a sifter or move them around like a puzzle. So there are some quick factors that will determine immediately which way we're going to go. So if the credit is on the lower side, um, FHA does allow for a lower credit score than a conventional loan. If they are a first time home buyer and maybe they're just getting started out, but they are going to have more money in the future, FHA does allow for a higher debt to income ratio. So if those two things are easily noticeable, then I already know in which direction we're going to be heading. It's an FHA loan. So then we have our conversations about the benefits of an FHA loan. On a conventional loan, it's a little bit more difficult to qualify for. The credit score has to be a little bit higher. The debt to income ratio is a little bit tighter. However, there are longer term benefits to taking a conventional loan, such as the PMI falling off once you have 20% equity in the property. Um, FHA does charge a one-time upfront premium that is added to the loan. If we can avoid that,
Mm.
it's better in the long run for those clients. Did I answer that question right?
You did.
I did. Okay.
So, just in case there are some listeners that don't know what PMI is, could you explain
Mhm.
that really quickly?
Yes. So PMI refers to private mortgage insurance. So way back in the day, you had to have 20% to put down to buy a house. That's what banks felt they were comfortable with. They wanted you to have that much skin in the game in order for them to lend money to you. So the government came along and they decided that they were going to help out. So they created a government program called FHA that allows for you to put as little as 3.5% down. So to make the lenders more comfortable, they created mortgage insurance. So FHA charges a one-time upfront premium, but then they also charge a monthly mortgage insurance that's attached to the loan. And basically it's the same thing as paying homeowners insurance.
Okay,
Like you're paying this money and if you were to default on the loan, FHA would reimburse the lender
great.
for that money.
Okay,
So this also happened with conventional loans as well. So private mortgage insurance companies came in with a conventional loan. If you're a first time home buyer, you can put as little as 3% down, and you're paying this monthly mortgage insurance as a like as a default for being able to put less money down. Basically, again, if you were to default on the loan, that private mortgage insurance company would pay the lender for their losses.
great. Thank you for
Yeah.
explaining that.
Mhm.
Let's talk about what happens if somebody gets denied for a mortgage and you can't find the right program for them?
Mhm.
Uh, what how do clients deal with that, and can they be offered less favorable terms due to a poor credit history or financial history?
Yeah, so there's your regular conforming loans where everybody's, qualifying by the same rules. So conventional loans, FHA loans. If your credit is not up to par for those loans, there are non-conforming loans that we can do. And I always tell my clients, you have to look at it from a lender's perspective as well. It's riskier for them. So they're going to charge a higher rate for it. So it's really a matter of running the math on it. So, does it make sense to the client to take this higher rate and buy this property? And during that, whatever the time period is, a year or 2 years after that they have to be in that product, we work on their credit, or for instance, if maybe they're self-employed and they don't show enough income on paper, can we get them to file their taxes differently, showing more income rather than writing more things off, to get them to a place where they'll be able to refinance into a regular type of mortgage. So I don't always look at it as a lender taking advantage of a client. They're offering a client a service, and they're assessing their risk, and they're charging appropriately for how they feel about it. But you, as the client, and your mortgage broker should be running the numbers and doing your due diligence to see whether or not that risk
Is
is
worth the
going to
reward.
work out for you. Yes. Yep.
That's great. Because you see in the news, predatory lending, and oh, I had to pay
Mhm.
a higher interest rate, but they don't ever talk about, oh, maybe you paid the higher interest rate because you are self-employed and you
Yes.
had to get a no doc loan, which is
Yes.
something that you don't have to provide tax returns or anything. So
Yeah.
like you said, it's a risk for the lender, but you're also getting the product that you need to do what you want to in your life at that moment.
That's exactly right. Like, a lot of my clients were like, "Oh my gosh, that's highway robbery." I'm like,
Mm.
"Well, would you lend money to somebody that hasn't showed any income on their taxes for a couple years?" Like, you have to look at it from the other perspective. So I always tell my clients, it's either you pay higher taxes, you don't write as much off, and then you buy the house, or vice versa. So when I put it that way, they kind of go, "Oh, okay, yeah." I mean, one way or the other, I have to make sure that I pay.
Right, exactly. Either Uncle Sam gets their money or the lender gets
Right.
their money.
Right.
And then speaking of like different ways people can do their taxes or things, what are some other common mistakes that borrowers make even before the mortgage process, during the mortgage process, and
Yeah.
how should they avoid them?
Okay, so common mistakes. I mean, somebody that's a first time home buyer that's never had any experience in how it works, they might go out and see a house that they fall in love with, and they're like, I want to make an offer on this house. I love it when I get a hold of my first time home buyers before they've gone out. So there's a couple of reasons for this. I want to do the pre-approval properly. Um, get their information, have a good conversation with them, and most importantly, get their paperwork. There's a lot that can happen once the paperwork comes in that you might not think is an issue, like large deposits into your bank account that we can't source, income not coming in traditionally the way that they might have stated it was going to be. So a full pre-approval, pre-qualification with documentation in, and then that way that your pre-approval is sound and the houses that you're looking at are not going to be an issue when it goes into underwriting. Okay, so one of the things that would be really helpful for most first-time home buyers to know is that with bank statements and confirming down payment, the government's very particular. They want to make sure that we're doing our due diligence in confirming where the money is coming from. Um, so there's a minimum requirement of a 2-month look back. So any large deposits that are not coming from your pay have to be sourced. So if they're cash, we can't use them. We have to be able to show that it came from your own resources, where you
Mm.
paid it. Is it a gift from a family member? So sometimes when I get people's bank statements, if they've got large deposits and it's like, I had $3,000 in a safe that I was planning on using for the purchase of this home. Well, we might have to wait an extra 2 to 3 months before we can actually use that money, because it has to be seasoned in their bank account for that amount of time. Really, the best advice I can give you is, if you're thinking about buying a home, or like, go and speak to a mortgage broker immediately. Get a pre-approval done, get your paperwork in, get yourself set up. And during that time period, where you're thinking about, buying a home, let your mortgage broker start running some of the numbers that your realtor has set on some of the houses that your realtor has sent over. Um, so you can get comfortable in knowing what you're going to need to bring to the table, what the monthly payment's going to look like, all of that sort of thing.
Great. I appreciate that. So let's pivot for a second. We've all been dealing with this thing for 3 years called COVID-19.
Mhm,
I know that as a realtor, it has greatly impacted the way I do business.
mhm.
How has the pandemic affected the mortgage and lending industry, and what changes do you think we can expect in the future?
So when the pandemic originally started, Fannie Mae and Freddie Mac did put out a lot of overlays on their programs. Basically, just extra due diligence to ensure that income that we're using will sustain through the pandemic. So just recently they loosened up these rules. So it's going back to what the rules originally looked like. So when you're self-employed, there's still minimum due diligence required, which is a 2-year look back. How has that business been operating over the last 2 years? How much have you been netting from your income from that business? We used to have to provide a lot of documentation confirming where the business is at currently within this year. I actually think all of those are good practices. Like, again, if I am lending out money, I want to make sure that this person is in a good place to be able to still make these mortgage payments in the upcoming years. Credit was affected. Obviously, a lot of people's employments came to a screeching halt. Self employed businesses weren't able to operate. But every lender, I mean, we've been looking at credit bureaus for over 20 years, and everybody's life has a spot on it or a bunch of spots on it where you can tell that something serious happened.
Mm.
However, what happened after that? Were they able to rebuild? Did they take immediate action and start, paying off their debts when funds did start coming in? So people are building back out from any credit issues that they had had during COVID. And again, that's where we are here to help them. How quickly can they bring their score up, and what kind of advice can I give them to help them get to that faster?
Great.
Mhm.
Uh, so you had mentioned that they're loosening up regulations. How do you stay up to date on changing in these lending regulations, and what impact do the regulations have on your overall process of getting someone qualified?
Um, my clients would probably say that there's a lot because it is a lot. Like, there's a lot of paperwork that's
Mm.
required, and I try my best to explain why all of this paperwork is required. Um, but what are we doing here? Oh yeah, so the regulatory agencies are really great at sending out information. So anytime that there is a change, it's automatically emailed to us.
Oh, great.
Then, because I'm a mortgage broker, I work with a plethora of different mortgage companies, and all of them are exemplary at sending out updates. They provide podcasts, they provide classes so that you can like educate yourself on what the changes are. Um, like lots and lots of stuff to read as well. So every single day as the rules change, we're just reading and moving with the flow and understanding moving forward, like, what do my existing clients that I have in the books right now that are looking for homes, how is it going to affect them? And with new clients that are coming through the door, I just have to switch the view and move in that way. So as an example, FHA is bringing down the percentage at which it charges its monthly mortgage insurance, and
Oh,
that's
great.
that's taking effect in March. So it's actually coming down quite a bit. It's going from 0.85 down to like 0.55. So it's a big deal for first time home buyers.
Yeah, I saw an article about this, and they said it saves the average home buyer about $500 a year.
Yeah, yes, exactly. So it's small, but it over time it really adds up.
Yeah.
Yeah.
So let's talk about something positive, right? Like
Mhm.
what's a recent successful transaction that you worked on, and what did you do to make it, if anything, to make it successful?
Okay. So I've had 3 refinances in the past month that these poor people and they had title issues. So just for your viewers out there so that they can understand, whenever you're purchasing or refinancing a home, there's a title company that is charged with ensuring that all previous liens, encumbrances, judgments have been released from the property. When the new mortgage that you take is applied to the property, it has to be in first position. So they want to make sure that you don't carry any other debt or that you're not buying a house and taking over somebody's debt. So with these refinances, our clients, I mean, they've owned the home previously, but the previous title companies had not discharged any of their liens. There was a cobweb of liens all over these properties.
Oh, wow.
So a refinance that should have took 30 days, all of them were like 60 to 90 days. So I think of these as success because my team worked diligently with the title company. So I'm very fortunate that I had a great title company that I worked with too on these transactions. So we had to dig backwards and figure out where are these liens coming from, get a hold of these old lenders. get a hold of their legal departments and figure out why these things were not discharged. Then we have to get them discharged, and we have to get the title company to register all of these things. So that takes a lot of people working diligently every single day to do it. And with a refinance, like if you were working with a big bank, this would get lost in the fray so easily because it's not a purchase, it's not immediate, there's no urgency,
Mhm.
it's not the same urgency as a purchase would
Right.
be.
They're living in the property, so it's not like they have to move or, there's not a seller
Yes.
involved. Right. I get it.
Right. But my buyers have rate locks that are going to expire. They have programs that special programs that I'm using that maybe I don't have a rate lock extension available for. So um, the team that I have, my assistant, my title company, my processors, they took what was a really ugly, sticky situation and really not my borrower's fault at all. When he closed his transaction, when he bought his house, these people were supposed to be releasing all those things immediately. So
Mhm.
I was very proud of my team that they were able to clean the cobwebs and get the deals done.
Right. Now, let's talk about someone who's considering buying a home or refinancing. What advice would you give them to get ready and and to help them deal with something like this that came up to keep
Mm.
a cool head?
Oh, okay. So I do try to warn my clients too. I like to say at the beginning of the process, like, we're going to be best friends until the day, like, you'll love me when you're at the day of settlement. But I prepare them. It's a lot of paperwork. You're asking somebody to lend you like three or $400,000. So they have their processes and the processes are in place because they've been fooled many times. And
Mhm.
not saying that these borrowers are at all shady, but they have to follow the same rules that everybody else does. So I ask my clients, please don't move money around. Like if you've got it in these bank accounts, just leave it in these bank accounts and don't move anything until you're ready to settle. And also, if you do feel like you have to move something, just call me first and let me
Mhm.
know, even in the pre approval process. If you're planning on opening up debt, let me know. Your debt to income ratio might very well be able to afford putting something else into it, but oftentimes no, you can't.
Yeah.
One time I found a client in Home Depot. We were in the middle of a transaction. They were buying a house. And I was like, what are you doing here? She's like, oh, we're buying a lawnmower. I'm like, no, you're not. Get home. You're buying that lawnmower the day after settlement.
So it's so funny that you say that because I guess it was when I first started, maybe 1 or 2 years in, somebody bought a boat.
No.
Yes, it's funny. Like people don't think about how that's going to affect them
Yeah,
when they just think, oh, it's completely normal to buy a boat the day before I
I
buy a
know.
house,
Yeah.
um, or a lawnmower.
I know, but that's the reason that this is the reason why you have to have these conversations with your clients before. And I think realtors are really good at doing that too. Like usually your realtor is working in tandem with you to be like, we're under contract. Do not do these things before settlement.
So
Yeah.
um, now on a different note,
Mhm.
so let me ask you to take off your mortgage broker hat and use your knowledge for the buyers that want to try and negotiate better terms or better rates for themselves, especially in this landscape that we have now. Last week we're up over 7% again,
Yeah.
and it looks like this month the Fed is going to do 50 basis points
Mhm.
on the prime rate um, instead of 25 to kind of quell inflation. Like, what can buyers do? Is there any negotiation on these rates, like other than
Mhm.
trying to shop around or go with like a discount person on the internet that gives you a
Mhm.
teaser rate, and then later on they're upping it when you go do your rate lock? Like, what can we do?
Yeah. Okay. Well, so I I can't take off the mortgage broker hat because I know too much. So
Okay,
I know what's on the other side of the curtain.
okay.
Okay. So it's really like, this is just, and I'm not being self-serving here. I'm here being a mortgage broker because um it's where there's least amount of cost. So just as an example, like a bigger lender has a lot of overhead.
Mm,
They've got employees that work for them, sales managers that work for them, lights, office people, closing departments, all of that stuff.
So you're talking about
So
big banks, like
big banks,
okay.
even like just regular lenders too, like
Mm,
they all have costs that are built in, like they have to be able to pay their employees.
mm,
And so their profit is coming from the income that's being earned from these mortgages. So all of those things have to be put into the rate. So every lender doesn't, there's never one single lender that's always going to consistently have the lowest rate out there. Like they might go and have a special and like, for 2 or 3 months, they're going to have the lowest rates out there and they're looking for volume, volume, volume. But there comes a certain point where that bank needs to slow down and replenish again. So as as a mortgage broker, like my husband and I went into brokerage business about 4 or 5 years ago, and that was because we spent a lot of time working for other people, and just having the knowledge that we have for so many years, I don't really need those bells and whistles anymore. So I was like, how can I get to the place where I have access to the lowest rates? So that I don't have to constantly be trying to sell a client on a rate that is higher. Like I never liked that idea anyways. If my clients would come to me and show me, well, I have this rate and they show me the loan estimate, I'd be like, that's the better deal. Like obviously that's what's better for you. So a mortgage broker works for you. We don't work for a lender. So my job when I wake up in the morning and I start running numbers for my client, I'm literally pulling up all the different lenders that are out there. And if there's a lender that's out there that has a better rate, I can sign up with them. Like if I can always have that discussion with a client, I can say, listen, this lender has a great rate, but maybe they don't offer the best service. And if you have a 30-day close, like I'm not going to guarantee that to you. So we have these conversations. Like for an eighth of a point more, we can go with a lender that's going to close you on time. So I think that you need to be able to work with somebody that has options to give you,
mm.
that has options for programs where they might be able to help you with first time home buyer things, to be able to offer you the lowest rate, to offer you arm products and all of the different things that are out there. So um, I guess maybe if I didn't have my broker hat on, I would say do your due diligence by speaking to a couple different banks. I wouldn't recommend pulling your credit with every different bank,
Mm,
but if you can find a mortgage broker, their job is literally to shop for you.
great.
Yeah.
Awesome.
Mhm.
Now, um, you said, the mortgage brokers and lenders, they make money off these fees. How do you ensure your clients understand all the terms and the fees associated with their mortgage? And what steps do you take to make sure the process is as transparent as possible?
Yeah. Okay. Yeah. I mean, that's my main goal with my clients too. Cause can you imagine not having, well, yes, we all can. We've all bought a home. Um, it's just like, what does all that mean? Like it's $17,000 for closing costs. Like what is all included in that?
Hmm.
So I mean, so the loan estimate that goes out to the client in the very beginning of the process, I usually do this during the pre-approval process too, just so that they can actually see what's involved in the breakdown. But the loan estimate does break down, what is all outside of your down payment, what are all the third party fees that are contributing to this $17,000? And how does that change from house to house? And how can I get it low enough? So when it comes to mortgages, math can be broken down. Like we just have to show them a picture of it. So once I give them a breakdown of what's all included in the closing costs, then moving forward, when we run numbers on properties, I don't have to show them that breakdown every time. They just know, okay, this is a complete calculation of all of the third party fees that are going into this transaction. And little known fact, by law, we have to correctly estimate to our client what the estimated closing costs will be at settlement. And we have to be within a pretty close range. Otherwise, we have to pay for it out of our own
Oh,
pockets.
interesting.
So, yes. So we don't sugarcoat it ever to the client. You know what I mean? Like it's something that we can't lie about when it comes to closing costs. So that's why I always ask my clients, like if they come to me and they say, "Oh, well, their closing costs are, $4,000 less," and I'm like, "There's no way. Like, let me see what they're talking about over there because it will look differently at the settlement table." So,
All right, great.
yep.
So as we go through the process now, we've talked about how to get approved, how to get ready. Now, what if we're under contract and we have this Appraisal, right? Like everybody's always worried about appraisals. Is the house worth as much as we said we're going to pay for it?
Mhm.
You know, talk about how you manage the appraisal process and what that looks like from your side and the buyer side.
Right. Well, I'm also pretty fortunate because I work with some really great realtors that are they're not dummies. They've probably already comped that house out. They probably already know the comps that the appraiser is going to use. So they usually do a really great job of preparing the client, especially during the pandemic when the prices of the houses were going over what the actual property was going to appraise for. You guys were so good at being like, listen, it's probably going to come in like 10 or 20 grand light. Like, are you prepared for this? And then we run the numbers for the client. So
Mhm.
the client's prepared for this. I've been fortunate that way. But the actual process with the appraisers, we are supposed to stay as unattached to that appraiser as possible. They're looking for a very unbiased report from that appraiser. So in the very beginning, when I get signed up with every lender, I can provide them with a roster of the appraisers that I like from the area that are trustworthy, quick, um, really understand the nuances of the different
Mhm.
areas that each city and neighborhood offers. So when we submit a request for an application, the appraisal management company that every lender has to use in the country, they all have their own appraisal management companies. They will choose an appraiser round robin. And
Mhm.
myself and the client and the buyer's agent won't know who that appraiser is. The listing agent will be contacted and the appraiser will come out to the house to go ahead and take a look at it. But until that report comes in, I won't know who is looking at it. So they're really supposed to be giving an unbiased report on what the market value of that house is at like in that time period. Because the market value of a house can change over time, as you know.
Mhm.
So they're taking a snapshot of where it looks like now. So that being said, Mike, we definitely have gone back and argued a few appraisals. You know, like you've done your due
Mhm.
diligence, you know what the value of that home is. Sometimes we get an appraisal where we just don't think that they've accurately assessed what the value is. So we've had a lot of success negotiating with appraisers, trying to get them like at least to meet maybe partway or halfway to get them where they need to be. So yeah, it's not the scariest thing in the entire world if you're properly prepared for it, which you guys do a really good job of doing with your clients.
Great.
Yeah.
I think that's kind of all the questions I had here. We spent, about 40 minutes talking today, and I really appreciate you sharing your experience and your knowledge with me and the listeners and viewers today. Is there anything that you want to say in closing? Maybe I don't know, just anything at all that you want to end your interview with?
Hmm. Well, I wish you lots of success with your podcast. I
Oh,
love
thank
this
you.
for you. You're so good at
Well, I
it.
appreciate that. Oh, you know what I want to ask? How can people get in touch with you? Are you on social? I know you have a TikTok now, right?
Yes, yes.
What are your handles on TikTok, Instagram,
Oh
stuff
my
like that?
gosh. Okay. Well, I'm not a social media. Obviously, I'm a mortgage agent, so I don't really have a giant creative side to me. I am trying, but anyways, I do have my company's name is America One Financial, and you can find my website at am the number one financial.com. They can reach me through email at Aimee at am1financial.com. I do have social media, but it is mostly mom stuff.
That's cool. Maybe there's moms out there that want to know what a working mom's
Yes,
like.
it's like mom and best friend stuff. And I know that like a lot of my lenders are like, okay, well, you should really work on your business. But I find that I've got a really great realtor base and a wonderful client base that I've built up over the year that do a wonderful job of referring me business. So
Awesome.
I do keep busy that way. Thank God I don't have to rely on social media because it would be a nightmare.
As we wrap up, I want to make sure that everyone clicks that like and follow button. Follow at Hungry Realtor on YouTube, Instagram, TikTok, and make sure to look out for Aimee at am1financial.com.
Yeah, perfect.
All right, awesome. Thank you so much, Aimee. You have a great day.
You too. Thanks, Mike.
And that wraps up another episode of the Hungry Realtor podcast. Please like and subscribe for more info.